Friends, I have a heartfelt question for you today. What are you investing in when you buy stocks? Are you focusing on the company's growth over the next decade and studying its fundamentals? Or are you chasing daily, short-term trends, investing wherever you can make the fastest gains? Or are you clinging to meme stocks in the hope of getting rich overnight? Everyone has their own answer. But yesterday, Wall Street's top traders offered a surprising answer. They were investing in junk stocks. You heard right. Stocks with poor fundamentals, once overlooked, are now favored by investors. Goldman Sachs traders bluntly stated that market logic has changed completely. Recession warnings keep coming, but who cares? The market is flooded with liquidity from interest rate cuts and fiscal stimulus. And consumers have adopted the mindset that money is depreciating, so they might as well spend it. Consequently, fear has been cast aside and replaced by a frenzy of fear of missing out. In other words, Wall Street is no longer based on trading fundamentals, but rather on trading liquidity, positions, and price trends. Does this scene sound similar to 1999 to you? During the dot-com bubble, fundamentals were ignored. Profitability wasn't important. What mattered were traffic and a compelling story. Consequently, the stock prices of thousands of unprofitable internet companies skyrocketed. Having a double quotes.com in the name alone could cause their Nasdaq stock price to multiply several times over. Pets.com is the most notable example. It had virtually no profit model and ultimately collapsed. Yet its initial public offering saw its stock price soar. Investors didn't realize their dreams were a lie until the bubble burst and the Nasdaq plummeted over 80% from its peak in 2 years. In hindsight, Pets.com wasn't the only company acting irrationally. At its peak in 1999, over 400 new internet companies were listed on the Nasdaq in a single year, and over half of them saw their stock prices double within a year. There were even absurdities in the market. For example, an e-commerce company called Eat, which had annual sales of only $30 million, saw its stock price soar to $8 billion. Another company, Webvan, raised over $1 billion based on its internet grocery delivery concept, but went bankrupt and liquidated within 2 years. These cases demonstrate that when market logic shifts from profit to storytelling, any subject matter can be inflated into a bubble. At the time, investors firmly believed that the internet would change the world. This led to stock prices rising 10 or even 20 years ahead of time as investors anticipated their dreams for the future. However, while the internet did change the world, 99% of companies failed. Only a handful of companies succeeded, such as Amazon and eBay. The rest were lost. Today's markets may seem different, but the logic is strikingly similar. AI, green energy, and biotechnology each promise a grand future. And investors are more inclined to pour money in first and see what happens later. The question is whether only a handful of investors will be able to make it out of this wave. Some lament that the current USSTOC market resembles that of 1999. However, an examination of the economic data reveals a host of conflicting signals. Freight volume and logistics prices are declining. Home sales have been sluggish for months, and the auto market is stagnating under the weight of high interest rates. With the threat of a recession looming, meanwhile, tech giants are investing heavily in AI. Defense orders are steadily growing, and demand for healthcare and services remains strong. Taken together, these data reflect only a fragmented reality, defying any coherent logic. But the market doesn't care. As long as there is liquidity and money keeps pouring in, stock prices will rise. As one Goldman Sachs trader put it, these days we're not trading fundamentals, but liquidity, positioning, and price action. Fear has disappeared, replaced by the new emotion of fear of missing out, the data bears this out. Over the past month, the Russell 2000 index, which represents small-cap stocks, rose by over 13%, while the S&P 500 rose by less than 7%. Notably, the Russell 2000 comprises small companies with poor profitability and limited risk tolerance, yet they are leading the market. Even more strikingly, CBO data shows that 7 of the 10 most traded stocks in the United States in May were penny stocks trading below $1, many of which were losing money yet remained the market's leading performers. Meanwhile, meme stocks have made a comeback. Companies that were long abandoned by the market, such as Opendoor and GoPro, have seen their share prices surge by dozens of points in a short period of time. This surge is fueled by retail investors on social media platforms and short-term institutional investment. They all have one thing in common: weak fundamentals and immense resilience, making them perfect vehicles for liquidity. This embodies the Wall Street traders saying, "We're no longer trading fundamentals. We're trading liquidity and price." The facts are clear that the surge in junk stocks isn't due to a company's sudden revival, but rather to liquidity finding an outlet. This is being fueled by FOMO, fear of missing out, which is driving the market higher. So, when junk stock concentration camps, like ARK funds, start outperforming the market and surpassing high-quality value stocks, realize that the fun has just begun. The question is whether this revelry will eventually turn into a major crash, as it did in 1999. Or will there really be enough liquidity to support a new rally this time? Setting those two questions aside for now, let's first understand how Wall Street is actually trading these junk stocks. Goldman Sachs traders explained it in their latest report. The current strategy is clear. Use style, hedging, and curve trading to push funds toward the most resilient areas. I'll explain these techniques in more detail later. Why do they do this? The logic is simple. In an era of abundant liquidity, companies with compelling stories are sought after enthusiastically by investors. While solid value stocks are dismissed as lacking imagination, data from the past few weeks speaks volumes. Junk, penny, and meme stocks have led the way in terms of trading volume and price gains. Investors are abandoning the logic of sound fundamentals and chasing volatility and short-term gains. To thoroughly explain this matter, we cannot just focus on the words crowded funds and heated sentiment. Let's break down the logic. First, they have the greatest elasticity. Junk stocks have small market caps and low bases. Therefore, once capital flows in, price fluctuations are magnified exponentially. Many unpopular small stocks can achieve gains in just a few days that would take others months. The driving force isn't sudden changes in performance, but rather the squeeze effect of capital on low liquidity pools. Second, there's ample room for storytelling. In the internet era, the saying "traffic is the future" was true today. However, it's AI, green energy, and life sciences are the future. As long as there's a compelling narrative, it can attract buyers, even if profits haven't materialized. ARKK boasts a significant proportion of these high-imagination, low-delivery companies, making it a natural fit for this market trend. Third, there are numerous leverage tools. Short-term options, such as ODTE, intensify short-term volatility. Small tickets are already light, and when combined with options and momentum factors, a positive feedback loop of price-volume option Greeks easily forms, amplifying gains over a short period of time. Fourth, social media is accelerating. The proliferation of platforms like Reddit, X, and Discord is amplifying sentiment even faster. The cycle of seeing someone make money and immediately following suit has shortened to hours. The intensity of public opinion has become a trading factor. Fifth, alternative outlets are limited. When there is insufficient bond market uncertainty and blue-chip valuations are stretched, incremental capital seeks more cost-effective volatility. Junk stocks are the most convenient option because they carry high risk, but also offer impressive performance in a short amount of time. In short, these companies are not suddenly excellent. They simply best fit the rules of this liquidity game. They are light, fast, able to tell stories, easy to leverage, and easy to ignite. The first strategy of Goldman Sachs is to engage in style hedging. What does that mean? Put simply, it involves buying resilient stocks with strong narratives, such as tech growth stocks in the Nasdaq 100, or investing in junk stock concentration camps like ARKK. Conversely, the company chooses to short small and mid-cap indices, such as the Russell 2000, and high-quality value stock funds, such as GVIP. Many people here might be wondering, doesn't the Russell 2000 represent small and mid-cap junk stocks too? Why are there long and short positions on junk stocks? The answer is that not all junk stocks are created equal. ARKK represents highly resilient junk stocks with compelling stories and themes, backed by promising concepts like AI, green energy, and biotech, the market is willing to embrace these stocks. However, most companies in the Russell 2000 lack potential for growth despite their small market caps. They are primarily regional, small, and medium-sized enterprises operating in traditional industries. Their fundamentals are equally fragile and unattractive, causing investors to consider them marginal junk. Goldman Sachs' strategy is to invest in star junk stocks while hedging with marginal junk stocks. In other words, they are speculating on resilience and storytelling rather than fundamentals. The second is the macro-level yield curve trade. Specifically, they mentioned a strategy called the 2S30S steepener, which involves going long on the spread between 2-year and 30-year Treasury bonds. Although it sounds complicated, the logic is actually very simple, betting that the gap between short-term and long-term interest rates will grow. If the economy weakens, the Fed will push down short-term interest rates, which will drive down the 2-year yield while leaving long-term rates unchanged and naturally steepening the curve. Conversely, if the economy continues to grow, long-term interest rates will rise, pushing up the 30-year yield and steepening the curve. In other words, this trade can be profitable, regardless of economic conditions, as long as you judge the timing correctly. Some might ask, if the economy enters a recession, wouldn't junk stocks crash first? Why does Wall Street continue to speculate on junk stocks while also trading in the bond market? The answer lies in their logic of coordinating stocks and bonds. In the stock market, they exploit liquidity premiums with highly resilient junk stocks. In the bond market, they hedge against macroeconomic risks with curve trading. Even if stock market speculation fails, the steepening curve in the bond market can help them potentially recoup their losses. For Wall Street, this isn't gambling, but a two-pronged strategy. The biggest difference between Wall Street and retail investors is this: dual track approach. Retail investors identify which stocks are reaching their daily limit or experiencing a surge and then follow suit, largely driven by emotion. Wall Street, on the other hand, plays a structural game. They know that junk stocks will outperform in the short term, so they invest their capital there while simultaneously hedging in the bond market. No matter how the market moves, they can find a way to profit. However, this raises another question. How long can this stage last when the entire market's rise is supported by junk stocks? History has already provided the answer. After the dot-com bubble burst in 1999, for example, the Nasdaq plummeted by 80% over the next 2 years, leaving many retail investors wiped out. Although the context is different today, the logic is strikingly similar. Once liquidity tightens, the collapse will accelerate due to abundant capital, amplified narratives, and heated sentiment. Even more noteworthy is that the current market structure is more fragile than it was in 1999. Why? Because there are now 3 additional amplifiers. First, the options market is booming. Trading volume in ODT options, which expire on the same day, has reached record highs. This means that price fluctuations are being amplified. Junk stocks are no longer fluctuating by 10% or 20%. Now, they can double or halve in a single day. Second, there's the issue of the resonance of quantitative funds. High-frequency trading and quantitative funds follow liquidity. Once a junk stock is fueled by capital, the algorithmic model quickly replicates, pushing capital to similar stocks. This results in comprehensive gains throughout the sector. Third, social media is fueling the market. Retail investors are coming together 100 times faster than in 1999. Hot threads on platforms like Reddit, X, and Discord can revive a long-dormant stock in a matter of hours. Together, these 3 forces make today's market more like an amplified version of Pass the Parcel. The gains are more dramatic, but so are the risks. So, the question arises, what exactly are you speculating on when you invest in stocks? If you follow Wall Street's lead with junk stocks, understand that you're not profiting from fundamentals, but from liquidity and sentiment. This kind of money comes and goes quickly. Goldman Sachs predicts a violent upward surge in the market over the next 3 to 6 months. However, if liquidity tightens slightly and sentiment suddenly reverses, today's winners could become tomorrow's losers. So, if we broaden our horizons a bit, what are the 3 possible scenarios for the U.S. stock market over the next 3 to 6 months? The first scenario is optimistic. Liquidity propels a new wave of growth. In this scenario, the Federal Reserve maintains accommodative policies. Fiscal stimulus continues, and consumption shows no significant decline. The market's liquidity valve also remains open. Consequently, junk stocks surge, highly resilient funds like ARKK hit new highs, and meme stocks periodically experience resurgences in popularity. The combined force of retail and institutional speculation propels the market to a higher level, similar to 1999, before the bubble burst. The Nasdaq surged dozens of percentage points in the final months. The second scenario, which is neutral, is underway. It involves increasing volatility and making money more difficult to obtain. While liquidity hasn't completely tightened, market divergence is becoming increasingly pronounced. The broader market index may maintain a volatile upward trend. But junk stocks are performing unevenly. Some surge by dozens of points in a single day, while others quietly halve in value. Retail investors and quantitative funds continue to play a high-stakes game of pass the parcel. But the pace has accelerated, the margin for error has narrowed, and making money has become much more difficult. Many will find that the junk stock they bought didn't soar, but instead became the last one standing. The third scenario is the most pessimistic, a stampede-like decline. This is also the most terrifying scenario. It could happen if the Federal Reserve is forced to slow the pace of interest rate cuts due to recurring inflation. If fiscal stimulus hits a bottleneck, causing market concerns about deficit risks, or if a star junk stock suddenly crashes, triggering a chain reaction, the entire sector could collapse instantly at that point. The herd effect would reverse, and everyone would rush to the exits simultaneously. The resulting decline would be more severe than a bear market driven by fundamentals. History shows that speculative market crashes often occur so quickly that investors don't have time to escape. No one can predict these three scenarios with 100% certainty. However, the key point has already been made by the Goldman Sachs trader. The current driving force of the U.S. stock market is not earnings and valuations, but rather liquidity and positioning. Breaking down the three scenarios into smaller pieces allows you to see the fate of different groups. In an optimistic scenario, highly resilient sectors such as ARK, penny stocks, and meme stocks would benefit the most. Retail short-term traders may continue to enjoy quick profits, and institutions will earn excess returns through structured pair trading. However, traditional value stocks will perform poorly, at best, tracking the broader market. In the neutral scenario, the belief that anything will go up if you buy it will give way to the belief that you must hit the right rhythm. Although the quantitative models and style rotation strategies relied upon by institutions will still find opportunities, retail investors are likely to be squeezed out by higher volatility. Buying too early or too late will leave them stranded. In other words, profitability will become dramatically more difficult. In the pessimistic scenario, risks erupt in a concentrated manner. Highly leveraged funds and speculators of junk stocks will bear the brunt of the impact, and a stampede could erase months of gains in a single day. While institutional investors may be able to hedge their losses in the bond market, retail investors have little recourse. Throughout history, countless speculative bubbles have burst, ultimately costing ordinary investors the most. Even if you decide to speculate in junk stocks on Wall Street, you must understand that you're not profiting from the company's value, but from the price difference of chips in the liquidity game. As long as the rules of the game remain the same, it can continue. However, once the rules change, retail investors without a safety net often suffer the most. As long as you understand this, you won't make a misjudgment. In other words, the market is a game today. Wall Street uses structured hedging to speculate on junk stocks while providing protection in the bond market. However, the real danger is if retail investors blindly chase high prices, focusing only on the upside without realizing there's no escape route when prices fall. So, friends, let's return to the initial question. What are you really speculating on when you invest in stocks? If you firmly believe in fundamentals, be careful. This market may not be illogical for the time being. If you're chasing emotions, be even more cautious because this feast will come and go quickly. Wall Street can use junk stocks to enjoy a liquidity frenzy, relying on the bond market to provide a safety net. But do ordinary investors have the means to do the same? They most likely rush in based on emotion and ultimately fail to get out. I want to remind everyone that the current U.S. stock market is more of a game driven by liquidity and psychology. The story can be beautiful and the gains can be substantial, but remember that every game has an end. When the music stops this time, will you be holding the chair or be thrown onto the stage? What are your thoughts on Wall Street speculation on junk stocks? Is this the beginning of a new bull market or a repeat of 1999? Please leave your thoughts in the comments section.